Before we get into it, like this video, share it with someone who'd find it interesting and subscribe to the channel. It's what keeps videos like this coming. Imagine packing up your life, moving across the world, and building a career outside China for 20 years. You earned a living, paid local taxes, and assumed your past financial life in China was long settled. Then, unexpectedly, tax authorities reach out. They are not asking about your recent tax return or last year's earnings. They are reaching back decades into your past, demanding accounting for income and assets you earned while living thousands of miles away. This is not an isolated mistake, a computer glitch, or a routine audit. It is part of a deliberate global campaign launched by China to track down and collect taxes from its citizens living overseas. The rules of economic engagement have changed completely. For decades, China operated on a simple and powerful implicit economic bargain. The national strategy was focused entirely on growth at all costs. The central government encouraged rapid expansion, aggressive market building, and massive wealth creation. Citizens were actively nudged to build businesses, invest globally, and move wealth across international borders to secure trade links and personal opportunities. If capital leaked abroad during that boom era, it was largely tolerated as the inevitable cost of rapid integration with global markets. That era of passive tolerance is officially over. China has fundamentally pivoted from prioritizing aggressive economic growth to enforcing strict fiscal extraction. The government is no longer focused merely on encouraging new wealth creation within its borders. It is now actively hunting down existing wealth wherever it resides around the globe. When a state shifts its core mandate from expanding the economic pie to harvesting whatever crumbs have drifted beyond its borders, every citizen holding international assets suddenly sits in the target zone. The underlying incentive structure driving national policy has inverted, transforming routine international financial lives into uncollected tax liabilities. To understand why this global tax push is happening right now, you have to look at the severe fiscal pressure building inside China. Domestic budget holes have grown massive across the country. Local governments face heavy debt burdens, declining land sales revenue, and rising operational costs. When traditional revenue sources dry up at home, a government is forced to seek new revenue streams to plug those budget holes. The mathematical reality leaves policymakers with very few choices. Taxing domestic businesses and struggling consumers even harder during an economic slowdown risks choking off what little domestic economic momentum remains. That leaves offshore capital as the single most attractive target on the map. Chinese tax authorities recognized that billions of dollars in untaxed income and capital sit quietly in foreign bank accounts, property holdings, and offshore investment portfolios across the globe. From the government's perspective, this overseas wealth represents an untapped reservoir of revenue generated by citizens who still owe allegiance and taxes. Back home, the incentive to plug immediate domestic budget deficits outweighs any long-term friction it creates with the global Chinese diaspora. The mechanism behind this global campaign is both broad and aggressive. Tax authorities in China have launched a coordinated global effort to identify, track, and assess citizens living overseas. Crucially, these tax collection efforts are retroactive, reaching back several decades. If you left China years ago, earned income in another jurisdiction, and assumed your foreign tax obligations were completely settled locally, Chinese authorities are re-evaluating those past years. That creates an extraordinary liability for citizens living abroad. Imagine receiving an unexpected demand for back taxes, interest, or penalties on income you earned in another country 10 or 20 years ago. Yet, crucial details about how this works in practice remain completely unknown. It is still unknown what specific technical mechanisms Chinese tax authorities are using to identify and track the offshore assets of citizens across foreign banking systems. It is also unclear whether tax authorities are prioritizing specific high net worth thresholds or casting a wide net across all overseas workers and middle-class emigrants. What is undeniable, however, is that decades of past financial history are suddenly open for state scrutiny. The global campaign does not stop at collecting past taxes, it also installs stricter controls on future capital movements. China is intensifying scrutiny on all future offshore capital flows. making it far harder for citizens to move money out of the country going forward. For citizens living abroad or planning to relocate, the exit doors are tightening rapidly. Every cross-border bank transfer, asset sale, and foreign investment faces heightened regulatory oversight and scrutiny. The long-term consequences of this policy shift are only beginning to take shape across the international landscape. It remains entirely unknown how this campaign of aggressive fiscal extraction will impact the willingness of Chinese citizens to hold assets or reside outside of China in the long term. Will overseas citizens choose to divest their foreign holdings, bring their capital back home, or attempt to sever their financial ties completely? We do not yet know the answer. What we do know is that holding capital abroad no longer offers the quiet safe haven it once did. The state's reach now extends as far as the global financial system permits. The shift from growth at all costs to fiscal extraction represents a fundamental turning point in how China interacts with global wealth. For decades, global integration meant money could flow outward to build international networks and personal security. Now, as severe domestic fiscal pressure forces the state to hunt for every available dollar to plug its budget holes, those same international networks are being converted into tax extraction channels. Please note that this information is for educational purposes only and does not constitute financial or tax guidance. But the structural economic lesson is clear. When governments face mounting debts and gaping budget holes, historical norms around taxation and financial privacy disappear overnight. The boundaries of state power expand to follow the money, no matter how many miles or decades lie between the taxpayer and the capital city. The question facing citizens is no longer whether offshore assets remain hidden, but when the tax assessment will arrive. That's it for this one. If you got something out of it, hit like, share it with someone who'd care, and subscribe so you don't miss the next one. It genuinely helps the channel grow, and there's a lot more coming.